Most homeowners focus on the mortgage payment. That's why they never notice the 8% they lose every year. Not to the bank, not to taxes, but to math they were never taught to calculate. Buying a house used to be one of the smartest financial decisions a middle-class family could make. That wasn't belief, it was arithmetic. But here's the problem. People are still using 1950s math to make 2020s decisions. Today, most buyers make the same mistake. They compare rent to the mortgage payment, and they stop thinking. That's where the damage starts, because the mortgage is not the cost of owning a home. When you account for every unavoidable cost, interest, taxes, maintenance, insurance, and the cost no calculator wants to show you, owning a house quietly drains about 8.11% of its value every single year. On a $400,000 home, that's over $32,000 per year, and there are 5 separate costs behind that number. The 5th one is the reason most rent versus buy advice is dangerously incomplete. Let's break down exactly where the money goes and when buying actually makes sense. Why buying a house used to work. Buying a home wasn't always controversial. For decades, it was one of the most reliable wealth-building tools available. Not because houses were special, but because the system was. Post-World War II America, land was cheap, credit was accessible. The government actively pushed home ownership. Most importantly, wages rose faster than debt. In the 1950s and 60s, a typical home cost 2 to 3 times annual income. Mortgage rates hovered around 4 to 6%. That combination mattered. Your mortgage payment stayed mostly fixed. Your income kept rising. Every year, the house became easier to afford. Home prices didn't explode. They rose roughly with inflation, plus 1 or 2%. Then, leverage amplified everything. With a 10 to 20% down payment, you controlled an asset 5 to 10 times larger than your cash. A 3% price increase didn't apply to your savings, it applied to the full value of the house. This is why your parents were right then. The American dream wasn't a slogan, it was arithmetic. But arithmetic only works when the inputs stay the same. They didn't. When the math broke. Fast forward to the early 2000s. Home prices feel high, but everyone says they always feel high. So buyers assume history will repeat itself. Then 2008 happens. Home values collapse. Equity evaporates. Mortgages don't adjust. A house worth $300,000 drops to $200,000, but the debt stays exactly the same. Selling locks in a loss. Refinancing becomes impossible. You're not underwater emotionally, you're underwater mathematically. In many regions, prices took 5 to 15 years to recover. But something else changed permanently. Wages stopped keeping up. Home prices didn't. For decades, homes cost 2 to 3 times income. Today, in many cities, they cost 5, 6, even 8 times income. At the same time, interest rates snapped higher. A $400,000 mortgage at 3% costs about $1,700 a month. At 7%, it's nearly $2,700. The house didn't improve. Your income didn't double, but the cost exploded. And buyers still make the same comparison. Rent versus mortgage payment. And they stop there. The illusion of affordable ownership. On paper, buying looks reasonable. Rent is $1,900. The mortgage is $2,300.400 more, and you're building equity. That logic feels responsible. It's also incomplete, because the mortgage is not the cost of ownership. It's only the entry fee. Once you own the house, the real costs begin. The 8.11% rule. When you add up every unavoidable cost of owning a home, the number converges around 8.11% of the home's value per year. Not a guess, not fear, just arithmetic. Here's how it breaks down. Mortgage interest. Early in a 30-year loan, most of your payment goes to the bank. On a $400,000 home at 6 to 7%, that's roughly $12,000 to $16,000 per year. Property taxes. National averages sit around 1 to 1.5%. another $4,000 to $6,000. Maintenance and repairs. Homes decay. Systems fail. Typically 1% to 2% per year, $4,000 to $8,000. Insurance. Usually 0.5% to 1%, $2,000 to $4,000. And now the fifth cost. The one most calculators quietly ignore, opportunity cost. That $80,000 down payment doesn't disappear, but it stops compounding. Invested at a real return of 7%, $80,000 becomes about $157,000 in 10 years. Over 20 years, it exceeds $300,000. In a house, that capital is illiquid, concentrated, and expensive to access. Selling costs 6% to 10%. Borrowing against it adds interest and risk. You have wealth, but it's trapped. Stack everything together, and the 8.11% number appears. On a $400,000 home, that's about $32,440 per year, over $2,700 per month. Suddenly, rent looks very different. Risk, flexibility, and invisible costs. Buying a home also concentrates risk. For most households, real estate represents 40% to 45% of net worth. One asset, one location. If the local economy thrives, you benefit. If it stagnates, so does your wealth. Flexibility disappears. Career moves become harder. Relocation becomes expensive. Renting it out adds management, maintenance, and stress. Buying a home isn't just choosing where you live, it's choosing how liquid your wealth is, how flexible your career remains, how much fixed pressure you accept every month. This isn't wrong, but it isn't free. When buying does make sense. Despite all of this, buying can still be the right move, but only under specific conditions. Buying starts to make sense when you plan to stay 7 to 10 years or longer. Your income and location are stable. Transaction costs can be spread over time, and the non-financial benefits genuinely matter. Stability, control, permanence. Those don't show up in spreadsheets, but they have real value. The mistake is assuming buying is automatically superior. It isn't, it's conditional. Conclusion: the smart money frame. Buying a home used to be the default path to wealth. Today it's just one option among many. Renting isn't throwing money away. Buying isn't guaranteed progress. The smartest move isn't following tradition. It's understanding the math before you lock decades of capital into a single decision. Because buying a home is not a housing decision. It's a capital allocation decision disguised as comfort. And it's not the 1950s anymore.